Good morning. I hope everybody's already had their second cup of coffee this morning. It's a little early to do a webinar, but we want to try something a little different. This is a pretty neat and exciting topic that we're going to be covering today, the employee retention credit. My name is Tracy Sharkey. I'm a partner in the firm. I'm located down in Dublin, Georgia, and joining me today is Alison Garrett. She is a tax partner up in our Sandy Springs office. Thank you, Alison, for joining us, because I know it's right in the middle of busy season and you're cranking out those tax returns, and so taking your time out to discuss this pretty important topic is super important. The employee retention tax credit has kind of been in the background since a year ago when the new tax act started coming out, providing some stimulus payments and some help for the employers. So we felt like this was a good time to bring it back up again, especially with the changes that have occurred in the last few months. Just a few housekeeping things. If you have questions during the presentation, there is, if you hover over the bottom of your screen, there's a Q&A portion or a Q&A button that you can click on. Drop your questions in there. We will answer those via email after the webinar is done. We feel like that'll give us the best use of our time to go through the material, because there's a lot here, and then address the questions afterwards. And then also we will email the slides to all the participants and then provide a link to the YouTube video. So if you happen to want to come back and watch it again, you'll be able to. All right, what we're going to cover today. So on the agenda, with the employee retention tax credit, this program's kind of broken up into pieces. So you have the requirements that were put in place for 2020, which were actually done by Congress early last year when we started dealing with the COVID-19 crisis. And then also, we just recently had 2021 updates, which expanded the program and then also made some changes to the 2020 program. We're going to discuss as well how the employee retention tax credit interacts with the PPP. So the Payroll Protection Act loan has been the darling of the stimulus payments these past 12 months. So deciding how to interact as you're applying for forgiveness is super important if you plan and if you qualify for this employee retention tax credit. So we're going to cover that too. And then we're going to discuss how to claim the credit. What do you need to do? What forms? Some considerations to keep in mind as you kind of go through that process. But before we get into that, we're going to do just a really quick poll. So if you'll just take a quick second and answer this question. Has COVID-19 financially impacted you? Brittany's going to give us a few seconds to let everybody be able to answer that poll. I think we ought to be getting close. So it's kind of spread out. I think we have around 60 people on the call. So 20% of you, or actually 35% of you, have been significantly impacted. 50% or roughly half or somewhat, and then 16% not at all. So good information. So during the course of the webinar today, you'll hear us talk about some of the other incentive programs that have been put in place. So 3 that have been pretty significant for our client base over the last 12 months. As I mentioned before, the Payroll Protection Act loans, the COVID sick pay. So when an employee is out because of being exposed to COVID or having to quarantine because they got a positive test, or having a child that could not attend school because school was closed, there are some sick and leave pay credits. And then lastly, the one that's important for us today is the employee retention credit. All of these interact on some level, so you will have some examples of that as we continue. At its very base, the employee retention tax credit is a refundable credit that you can claim on qualified wages. And Alison's going to tell us in a little bit exactly what those wages are and how you qualify. It also includes health insurance costs. So again, once you apply for this, you will be getting a refund for those payments against certain taxes. And again, Alison will go over that in a few minutes. One of the things, and we've done a lot of webinars, even internally, as we go through this process. And the one thing that has really stuck out that we're hearing that a lot of our peers are bringing to the forefront is this one phrase that the IRS has put out, that they're urging employers to take advantage of this credit, which is really unprecedented because very rarely do we as practitioners see the IRS urging the use of a credit for your tax planning. So this again is something that we feel like is pretty important for you to take a look at. And I'm going to turn it over to Alison now, and she's going to walk us through who's actually eligible and the wages, how you would calculate the wages.
Thanks, Tracy. Yeah, before we get started, the first thing I want to do is kind of give you a little insight as to the definition of an employer for this tax credit. I hear business owners all the time refer to their employees, and often they're referring to their 1099 subcontractors, who by definition are not employees. And that's a very important distinction with the IRS. So what we're talking about when we're talking about an employer and employees, we're talking about those people that you give a W-2 to. You provide them a W-2, you do withholdings for them, they have Social Security and the Medicare related wages. So just keep that in mind if you're a business owner who everybody is paid through contract labor. This is different. We're speaking specifically about those employees that receive a W-2. So on a very high level, so we're going to go into more detail on all of this. At the highest tier of eligibility, this is the first thing you're going to look at. You're going to look at your business and you're going to say, okay, did I experience a significant decline in gross receipts? And we'll go into the definition of significant decline in a few minutes because it's different for 20 versus 21. Or was I fully or partially suspended my business due to orders from federal, state government due to the COVID? We'll go into that in more detail. The significant decline in gross receipts is going to be our easy one. That's the one it's much easier to define that because you simply look at your financials and you're going to compare one quarter to the next. So it's kind of cut and dry, black and white. If you're trying to be eligible based on the fully or partially suspended, that's the one we got to dig a little deeper, maybe get into the gray. Tracy's going to go into that in just a little bit. And that's the one you got to be thinking. You got to be thinking geographically. You got to be thinking what industry you're in, and you got to be thinking very specifically your business because it doesn't impact everyone the same. You can go ahead, Tracy. So the time frames that we want to consider when we're looking at this is March 12th of 20 to December 31st of 20 is the original ERTC under the CARES Act. Now, as Tracy said, this was always there under the CARES Act, but because you couldn't do it if you had PPP funds, we really didn't pay much attention to it. It just knocked too many people out. Now that they've gone back and make this where if you got PPP funds, you can actually still get this credit, we're having to look at it a little harder. So the March 12th to December 31st is your first tier. That's when we go back and you file retroactively. Then you have tier 2 or time period 2, where it's January 1st of 2021 to June 30th of 2021. So that's your first and second quarter of 2021. There are different rules than in 2020, and we're going to go over that. So that affects your April 30th filing of your 941 and your July 31st filing of your quarter 2 941. Then you get into your third set of rules and changes, and that starts effective July 1st, and that's going to affect third and fourth quarter of 2021. they've tweaked it even further. So the rules for first and second quarter of 2021, surprise, they changed again for third and fourth quarter of 2021. We're still waiting on some guidance on that. Luckily, those quarters aren't here yet, and we'll know soon what we're going to do about that. So let's talk about the 2020 rules first. Like I said, it covers March 12th, 2020 through January, up until January 1st of 2021. So through December 31st. You can apply for this regardless of size, regardless of how many employees you have. You have to have had those fully or partially suspended wages, or I'm sorry, suspended operations, like we discussed, or a 50% or more decline in gross receipts. Now that's when you pull up your QuickBooks profit and loss and you look at quarter 2 of 2020 compared to quarter 2 of 2019. If 2020 has a 50% or more decline in gross receipts, that is an eligibility requirement. If you don't keep financials in QuickBooks or any other accounting software, you can also look at your bank deposits for those declines. That 50% is for 2020, and it will change in 2021. Now, the rule that changed is initially, as I said before, you could not have gotten this ERTC credit if you had gotten the PPP loan. And I'm sure some of you have already kind of looked at the dates and thought, well, wait a minute, that's smack dab in the middle of my forgiveness period and my calculations. And that's where we're talking about that convergence of those wages and where there's an issue. And we're going to go into more detail in that in a little bit as well. So even though you can have an unlimited number of full-time employees and get this credit, there is a very important number of employees you need to look at for 2020. And that number is 100. And the reason 100 is important is because if you had more than 100 employees, you can only use the wages for those employees that you basically pay to do nothing. You're stagnant workers, for lack of a better term. So if you had people that you were keeping on payroll, when you have more than 100 of them, just to kind of be kind, this is your opportunity to potentially get a little bit back in your pocket for that. Now, if you had 100 or fewer employees, you can potentially get this credit on all of them. And you don't have to have been paying them to not do any work. So that's going to impact a lot of us. Qualified wages include salaries, commissions, tips, similar compensation that are subject to FICA tax. Again, that's kind of where that W-2 comes in. If you are a restaurant and you have servers and their tips are not on their W-2, those don't count because you can't do cash compensation. That's down in the next part. So another key to note here is you cannot get the credit on wages paid to a relative or a dependent of the employer or to owners owning over 50% of the employer stock. Now, I know that's going to impact a lot of my clients. My S Corps that may be the only people on payroll are the two owners, maybe a husband and wife. And this little caveat is going to knock them out of this credit, unfortunately. So if they have a third employee that is not related to them, they can possibly get the credit on that third employee. But if they own more than 50% of the stock in the company or 50% of more than the capital and the profits, they're not going to be eligible to get the credit basically on themselves. Okay, so the credit calculation. For 2020, you get to take a credit of 50% of the qualified wages up to $10,000. And that includes those healthcare costs that are allowed. That's per employee, and that's for the entire year. So in a perfect world, the maximum credit anybody would get on any employee that is paid $10,000 would be $5,000 for the entire year of 2020. Now, that doesn't have to be in one quarter. That could be spread out over multiple quarters. And it might take, depending upon the wages of your employees, it might take 3 quarters for you to hit $10,000 of qualified wages. And as long as the 50% decline, or as long as the partial or full operations is met, you may still hit that for that client. I'm sorry, for that customer. And I think we've got another quick little poll. Based on what we've talked about, which I acknowledge is high level, do you think your company might qualify for ERTC?
Brittany's going to let that run for a few minutes, or a few, maybe another 30 seconds or so. So yes, we've got quite a few, Alison. A little over half.
Okay. So now that we've gone over the high level for 20, what qualifies you, let's look at first quarter and second quarter 2021. There have been a few tweaks, of course, and they are to the benefit of our employers. So once again, regardless of size, regardless of number of employees, you could potentially qualify. They have added tax exempt organizations. They may now be eligible for Q1 and Q2 of 2021. They were not eligible in 20. That includes state and local governments. And the rules also include employers who didn't exist in 2019. They can potentially now get the credit Q1 and Q2 of 2021, because they can look back at the corresponding quarter of 2020 to meet that gross receipts test. So at the end of each quarter, you had to have either had your operations fully or partially suspended, or you have had to have had a 20% decline in gross receipts. Now remember, 2020 was 50%. 20% is much more reasonable and attainable for a lot of businesses. And like I stated before, to qualify for these credits under the gross receipts test is just simplifies your whole world as far as not having to go dig and figure out and analyze what makes me qualify. So if you have that 20% drop, you need to be thinking about that. Now, Tracy, there's a special rule, I believe, that just came out as well regarding fourth quarter 20 and Q1 of 2021.
That's correct. So up to this point, you are comparing your current quarter that you're eligible or looking to be eligible for the credit to that corresponding quarter in 2019. So with the act that passed a few weeks ago that President Biden put in place, there was a clause in there that will allow you to elect for this first quarter to consider your fourth quarter 2020 collections comparing to your fourth quarter 2019 in order to be eligible for your first quarter in 2021. So you have to elect to do that. So that allows you to look back to that previous quarter versus waiting until the end of this quarter to see how your collections turned out. So again, that was something that got put in at the last minute there. We don't have guidance from the IRS on that yet, but it's pretty clear in the new act that came out.
Yeah, that's pretty huge. So in addition to, let's see, in addition to changing the gross receipts down to 20%, you now have a 500 full-time employees to kind of look at. 2020 was 100. And just to quickly recap, if you had more than 100 employees, you could only get the credit on those that you paid that weren't working. And if it was 100 or less, you could take the credit potentially on all wages. So now we've bumped it up to 500. That's kind of our threshold. So if you have more than 500 full-time employees, You can only claim the credit for those that were not providing services, those that you basically kept on payroll, but there wasn't really anything for them to do. If you had 500 or fewer, you can claim it on all potential employees, working or not. And one thing I want to point out here is this says full-time employees. We're not talking full-time equivalents. And some of our businesses that have to deal with those type of calculations, I believe for ACA and some other things, this is not full-time equivalents. This is full-time employees. And there are specific rules on this. This is actually easier to attain and a little less complicated to calculate. So the other thing that changed very much in the employer's favor in 2021 is the wages that can be calculated. It's still $10,000 per employee maximum, but now it's 70% of that $10,000. So it's $7,000 per employee maximum available. In 2020, if you'll remember, we had a $5,000 annual cap per employee. This $7,000 cap is per quarter. So you now have the availability to potentially get this credit. $7,000 first quarter, $7,000 second quarter. So not only have we made a much larger number of employees that we can access, but we've got higher wages and we're not limited quite as much. So right now, between 2020 and first and second quarter of 2021, we're already up to 19,000 potentially. Those are real dollars, and that's why we felt like this was so important to go over. So now we get our changes for Q3 and Q4. So these things came in with the American Rescue Plan Act. This is the one that was just signed in March 11th. And it extends the credit for Q3, Q4 2021. It has some special rules in it that we're still waiting for guidance on, but some of the things to keep a lookout for is we're expecting the Form 941 to change because we're expecting them to allow the credit to be against additional taxes than what the other one was for. They also expanded for some of the hardest hit businesses, including some of our businesses that have over 500 employees. They've changed the rules a little bit on that, and we're still waiting to hear for that. As of right now, we do expect it to still be that same max of 7,000 per quarter. But again, we're waiting to see how all this is going to come together for Q3 and Q4. Luckily, we don't have to deal with that for a few more months, but it'll be here before we know it.
And Alison, I think they were defining when they talk about the hardest hit businesses is the ones that are seeing the reduction in gross receipts that are up to like 90%.
Yes.
So that's where if you have an employer that's over 500 employees, but they're having some really significant impacts at that level, then the credit gets fully expanded for them.
Thank you. So we've got the next couple pages are just kind of a chart summarizing 2020 and 2021 because it's hard to keep it all straight. The details start to blur. I get it. We're living it. It does for us as well. So here's a little cheat sheet for you. Once you get a copy of this presentation, you can check it, look at it, read over it with a clear mind, and start to think, okay, does that apply to me or not? And just look at the details of that.
And again, everybody will get a copy of this when they get the presentation.
So I've mentioned gross receipts several times. I've mentioned that it needs to be a 50% reduction of gross receipts in 2020, a 20% of gross receipts in 2021, but I haven't defined gross receipts for you. One thing I do want to mention here is in Georgia, we haven't had the shutdowns to the same degree as New York and California. We've been very blessed that we were able to go. For a lot of industries, you know, we just kind of switched to maybe virtual and we've kept trucking along. So if you can qualify under the gross receipts test. First of all, you will qualify that quarter, you qualify, and the next quarter you automatically qualify for the credit. So it's expanded, it's easier. Like I said, it's black and white, it's better, it's easier to define. So when you're trying to determine, particularly for 2021, if you qualify for this credit, I would check your gross receipts first, because that's going to be the easiest way to get this done. Now, for taxable entities, gross receipts is probably what most people would think it is. It's your sales, net of returns and allowances. It's everything you received for services if you're in a service industry. But it also includes income from investments, interest, dividends, rents, royalties, and annuities. Those are type of things that you might not think about. You don't reduce your gross receipts by your cost of goods sold, but you may reduce it for the cost of capital assets sold. And you don't include amounts received for sales tax. So when you collect sales tax from a customer, you don't include that in your gross receipts, because that's really not your money. You're just passing it through to the state. For tax exempt entities, the gross amounts received are from all sources, and there's no reduction for associated costs. For example, contributions, gifts, grants, dues, and sale of goods. Now, there are special rules that apply for businesses that started in 2019 for the determination of the drop in gross receipts.
So Alison, I know it, with that, for the determination, if anybody started a business in 2019, there's some pretty specific examples in what the IRS put out just recently in one of their notices, and we're going to provide a link for that in our last slide. But there are some, again, so for anybody that started, just opened up in 2019, you're not necessarily precluded from the credit because you weren't open the full year.
Tracy, before we leave gross receipts and turn it over to you for a full or partial suspension, I do want to mention that the gross receipts reduction does not have to be COVID related. It does not specifically say it's COVID related. You may be down in gross receipts just in your normal course of business, and that's okay. That is not a qualifier. And please keep in mind, to be eligible, it's the gross receipts test or the full or partial suspension, one or the other, not both. So Tracy, can you tell us more about this gray area I keep referring to in this full and partial suspension?
Yes, I will. So like Alison mentioned, I mean, you have your choice of hurdles that you have to get over before you qualify for this credit. Now, nobody likes to have a reduction in your gross receipts, but in this particular case, a reduction that meets those requirements will definitely get you across the wire for qualifying for this credit. The second qualification is going to be a little bit more difficult, especially here in Georgia, for all the reasons that Alison mentioned earlier, is because we were not shut down as long as some of our sister states, you know, across the US have been shut down. So it's not quite as cut and dried. And so really it's going to depend on an evaluation on a business by business to see how they were impacted. So for the next couple of slides, I'm going to walk you through, you know, what those definitions are and some ideas. So obviously fully suspended means you had to close your doors. You know, when Kemp came out, you know, in April of last year, late March, and came out with some specific orders, you were told you could not be open. So that, you know, again, if that's one of the cases, then fully suspended would qualify you for that. Partially suspended is where we get into a gray area. So you might continue to operate, but you weren't up to full speed for various reasons. And so you had to have been impacted more than just a nominal portion of your operations. All right, guidance for this is the best thing that we can point anybody to, and you can actually Google this. We've got a link at the end of the presentation. but the IRS just put out notice 2021-20. And again, a quick Google will take you right to it. Pages 24 to 44 discusses governmental orders and actually gives a lot of examples of what would be a partial or a full suspension of business. However, I want to point out that this notice is not law. It's just the IRS's first stab at giving us some recommendations and some examples. So when you look at it, don't take it necessarily as the end all when you're trying to apply it to your business, because again, this notice is not law, it's just an interpretation. So full suspension, complete shutdown. One of the things it mentions in the Q&A, if you just chose to shut down. So let's just say we had a business that was completely, they're really concerned about the COVID or impacts to their employees or their operations. So they shut the doors, but they continue to pay their employees. According to the Q&A, that cannot qualify you for the employee retention tax credit. However, you need to continue to explore that, because if there were other extenuating circumstances, there could be an opportunity for you to still qualify. And again, you'll see in Kemp's orders, you'll see in the IRS notice the discussion around essential and non-essential businesses. So for example, an essential business would be a grocery store or a medical practice, or in some cases, accounting firms were qualified as essential businesses. Just because you're in one of those categories does not disqualify you from having been impacted or having a partial suspension of business. So again, don't get hung up on those two terms. I've had a lot of clients call and say, well, we're qualified as essential, we probably won't qualify, but that is not a factor. All right, so some examples of partial suspension. And again, these are just examples. There could be many more, and that's where you really have to look at how you have changed your operations since this began last March. So supply chain issues. Let's just say, we've all been in the stores where the inventory looks really low. If you had an issue getting inventory, it just wasn't out there, that could be a potential qualifier for you. Occupancy restrictions. So let's just say, in Kemp's orders, he came out and restricted how many people could be in a building early on, where only so many people within a certain square footage could occupy. That could also qualify you as having a partial suspension. You couldn't go to trade shows. You couldn't have meetings with your clients. Maybe your on-site projects are being canceled or put off. That would also be a potential qualifying factor. Additional cleaning. There are a lot of situations where we heard, and you've seen yourself when going in some businesses, where after a certain number of customers have come in, they have to shut down or have reduced hours to do a full cleaning of the business location. That could be a potential qualifying factor. Other examples that revolve around certain industries, with the court system being closed. So if you are a law firm that had to be in court on a daily basis, and all of a sudden that was getting pushed off or suspended, that's also an issue. And then even on the medical side, if you had all your elective procedures canceled for your patients, again, that's a consideration for a qualifying factor. So these aren't all inclusive, but they're just some examples to really start thinking about, what did change about how I did business, and how did it impact me going forward? And again, the IRS, has come out and said it just has to be more than nominal.
Tracy, can I give a quick example that might maybe resonate with some people?
Sure.
Just to show how simple this is. So fast food industry, fast food restaurants. In our experience, what we're seeing, many of them, their actual sales were the same or up, because people weren't, were at home, but they couldn't go out to eat or whatever. But many of them had their actual dining room was closed or limited. So if the normal revenue created from in dining room eating was more than nominal, they may qualify. even if drive-through sales surpassed it and made them overall be making money. Another quick example might be a construction firm. Maybe they are having supply chain issues, getting supplies. Maybe they're having trouble getting COs because of the court system being closed. Maybe they're limited to how many tradesmen they can have at a time on site. Those things could qualify as a potential. So you got to think of your business, and you got to think of these things and think of how it impacted you, and almost think out of the box a little bit. But the potential is there.
And that's very true. A lot of businesses had to completely rework how they did their jobs. And so there was a period of time that there was a lot of change going on. So for anybody that's really considering or has, the thought in place that I'm not qualifying under the gross receipts, but we did change, we had to change significantly or more than nominally. What I would recommend is go to Kemp's orders, or the shelter in place that was actually put in place by Governor Kemp. The statewide shelter in place, if you think back to last year, occurred on April 2nd. His orders that were put out after that did not change it to just the vulnerable population until May 28th of 2020. Now, there were orders that came after that continued to make recommendations, that continued to discuss how we needed to interact to help prevent or fight the COVID-19 crisis. But that time frame, April 2nd to May 28th, is the one that we're looking at, that had the shelter in place active. And just some of the things, and why I encourage businesses to say, let's pull down these orders and let's look what is in the order and how it impacted you, because there's a lot of detail in these orders on what recommendations are, what things are required, and it varies based on industry too. You'll see a lot on grocery stores, restaurants, things like that. And then what you heard in the news, the bars, the hairdressers, things like that. But there's also specific requirements in there for all the rest of the ones that were not specifically named. So again, I would encourage you to look at those orders, and we're going to have a link that will take you or guide you to those orders too.
Tracy, they also need to be sure they're looking at their local orders. Because if we remember, City of Atlanta they put a curfew in place, and so you couldn't, if you were a restaurant, and I don't live in City of Atlanta, that's by choice, I tell you, but I believe it's like 10 o'clock. People had to be at home. So if you were a restaurant, you might have had to close early. So if you don't see something in the Kemp's orders, think locally, think where you are, city, county, whatever, and narrow that and see if you can find something that will help you qualify.
All right, another quick poll. Yeah, the next topic is near and dear to my heart, and that's on the PPP loans and how they're going to interact. Or we'll come on that pretty quick. I think Allison's going to tell us first about how to claim the credit.
Oh yeah, you're not getting rid of me yet. I have more good stuff for you.
So we got a little over half. That's interesting. So if you look at the numbers now, as far as what the SBA is putting out, there's roughly about 35% of the outstanding PPP loans. I think the numbers came out a couple of weeks ago. So about 35% have actually applied for forgiveness. So there's still a lot to come. All right, claiming the credit, Alison.
Okay, so we've talked about these potential credits and who might qualify, and then I'm sure you're thinking, well, how do I get the money? Well, let me tell you, for 2020, it's retroactive. You've got to go back in those quarters that you qualify and file a 941X. 941 is a quarterly payroll form, as many of you may know, and a 941X is where you can modify that to claim the credit. Now, downside, that has to be filed by paper. So that is not going to be a quick credit. You can also file retroactively for 2021. So if you get into May of 2021 and you realize, oh, I actually qualified for some of that credit first quarter 2021, you can again file the 941X and get the refund that way. You could also file it on the current quarter you're in. So for example, we're in first quarter 2021 and we're near the end of the quarter, just a few days left. If you know that you are going to reach it for this quarter, then you can actually apply for the credit on the currently filed Form 941. Now, when you do that, that is filed electronically. So that credit is a little quicker to hit your pocketbook than having to go back and file paper. But you also have to know you qualify for it. And just one little caveat, let me mention, if you got PPP round 2, be careful, because as Tracy's about to explain, you got to watch those wages. You can't take the same wages for both. So you may think on the surface, oh, I qualified, but you got to think about when you got your PPP round 2 money. And she could talk about that more. Now, if you think you're going to qualify and you want to get an advance payment of the credit in 2021, you can file a Form 7200. Downside of that is, again, it's paper file. And I think it's on the next slide. IRS is way behind. And to be honest, we've already been notified that they have second quarter 2020 payroll tax returns that haven't been filed. Some of you may have gotten notices. I've had some clients get IRS notices saying they haven't received their fourth quarter 940 form, but they've sure did cash the check. So they've got issues. They're trying. They'll get there. But anytime you got to do the paper filing, there's a backlog. And right now what we're hearing is potentially 6 to 8 months. So it's still worth it. It's still cash in your pocket. You just got to be patient about it. The other danger of filing that Form 7200, which you're basically getting the credit in advance, is you may get to the end of the quarter and maybe you didn't qualify. Like maybe you thought your wages, your gross receipts going to be down by 20%. Maybe they were down by 19 and you missed it and you didn't qualify. Well, then you've gotten this advance credit and it just kind of complicates your payroll tax filings. Now, one thing you can do to speed up this cash in your pocket, particularly if you don't use a third-party payroll processor, ADP, Paychex, Paycor, there's other ones, Intuit, when they do the filings for you, those would be all third-party payroll processors. If you don't use those, if you do your payroll yourself, or you do it in QuickBooks, but you actually are the one that makes your deposits, or maybe you have us doing those calculations and telling you what the deposits are, you could actually, on your 941, take that overpayment and either apply it to the next quarter or potentially reduce your next 941 deposit so that you keep that cash in your pocket. I will caution you that that means you've got to do some tracking. That means you or somebody has got to keep up with that. And it can be a bit of a hassle. If you use a third-party processor, you probably just want to go on and get that credit refunded to you. The 941 will be electronically filed, so it'll be a little bit quicker to get the money back. And I don't think that's in the slides, but a side note here, if you do use a third-party processor, you need to get in contact with them on how to get this credit because they're not going to know if you qualify. So you've got to be in contact with them. And if you have a PEO, which is an employer utilization, yay, it was in there, then you especially have to get in touch with them because your payroll processors, for instance, if you have ADP or Paychex, when the quarter ends March 31st, quite often they're processing those forms April 1st, 2nd, 3rd. So you got to get on that now if you think you qualified for first quarter 2021 and communicate that with them. And if you are doing it in-house, or if we're maybe perhaps doing it for you, make sure you communicate with us that you think you qualify so we can help you make that determination.
Yeah, there's definitely still time to bring that up and start planning for it before those first quarter payroll returns start being done. I think the only other thing too, before we move on to the PPP, is that the IRS again has weighed in and said that the wages that are being used to calculate this are not going to be deductible.
Mhm.
So that is a consideration. However, the receipt of the tax credit itself is not taxable.
Yeah, you're right, Tracy, which still makes it, worth your while. It's not quite the bang for your buck that you get in the PPP, where you got the money and you still got to keep the deductions, which just still kind of blows my mind, because that just goes against every accounting principle I was ever taught. But that's okay. We get the benefit from it. And that's why it's the importance of looking at the PPP and the credit is so vital to this. And that's why Tracy's going to go into that in a little bit more detail.
Yes, and so we're going to bring this home. I think we've got roughly about maybe about 10 more minutes. So we'll try to move through this quickly so we don't keep you over your hour limit. But using the PPP in conjunction with this employee retention tax credit. So the IRS has weighed in, and they're not going to let us double benefit by using this along with some of the other programs. And specifically, we're talking about the leave credits that we mentioned earlier, the work opportunity credit, the research and development credit, which is actually a change from earlier this past year. We did not think that it would have an issue with the employee retention tax credit, but it will. And then obviously the forgiveness on the PPP loan. So in this, what we're going to spend the next few minutes on is the PPP loan itself. Just a real high overview, the forgiveness process. I mean, right now we're dealing with 3 different forms to be able to use to ask for forgiveness for your loan. The time frame for your covered period is 8 to 24 weeks. And this is all the same whether you're dealing with a round 1 loan or a round 2 loan. You have to continue to use 60% of the loan for payroll or payroll related costs like health insurance, things like that, retirement plan cost or matching. And then there's 40% on non-payroll costs. And that's where it gets really important if you think you qualify for the employee retention tax credit. So again, I'm not going to spend a ton of time on here so we can keep moving through, but just to make it clear, you have a lot of people have a misconception about when they have to apply for forgiveness. You have up until the due date of your loan, which can be either 2 years or 5 years from when you get that PPP loan. So if you go back to your loan document, take a look at it and see. So our point here, and it's one that we have made to a lot of clients along the way, is don't get into a rush about applying for forgiveness at this point in time, because the continued legislation that comes out has been more positive and better. So in this particular case, it's paying to wait on this forgiveness application. All right, one of the things that got changed late in the year that was a positive, especially if you're considering the employee retention tax credit, is the expenses. So I mentioned before, 60% has to be spent on payroll. The other 40% they've expanded. So what they've added is operations expenditures, property damage costs. Now, again, we weren't in an area that had a lot of riots like some of our other areas across the country, but that is a cost that could be considered. Supplier costs. So let's just say right when you got your PPP loan, you had committed to buying a certain amount of supplies. You can consider that. And then any worker protection costs that you have to protect your employees from being exposed to COVID-19. Maybe that might be buying supplies or masks or extra cleaning. So again, that 40% of extra cost got expanded significantly. So what I want to do next is kind of walk you through how the PPP is interacting with this employee retention credit. So we've got a situation here where we have a business that applied for and received $200,000 PPP loan. They also incurred $200,000 in wages and incurred $80,000 in what we would consider eligible other costs. So that's the 40% that we've been mentioning. So we're going to walk through 3 scenarios to show you how this plays out with your forgiveness application. All right, so the first scenario, the business applies for forgiveness. And again, remember they had a $200,000 loan and they had $200,000 in payroll. So on their application, they used $200,000 in payroll against the loan. They're 100% forgiven because they met the requirements. They had over 60% cost allocated to payroll. They put 0 cost for the other 40%. They wanted to do it easy, get it out of the way and get it done. So 100% went to payroll. So for that period of time, if they qualified for the employee retention tax credit, those wages used for this application would not be eligible for the PPP. All right, let's roll to scenario 2. So our same set of facts. Instead of putting the full 200, the employer puts 160,000 down. He comes up with $40,000 in other costs that are PPP eligible. That leaves him $40,000 of his wages that he can consider for the employee retention tax credit. Then move on to scenario 3. He puts the minimum on his application. He knows he has to have 60% of payroll, which is for him is $120,000. He fully utilizes the 40%, uses $80,000 worth of other costs. That allows him, again, if he's eligible for the retention credit, to have $80,000 of payroll that he now can apply in the employee retention credit. Now, a lot of folks who are dealing with this now are thinking through, how do I allocate my payrolls? At this point, we don't have specific guidance from the IRS on that. So with them being silent at this point, reviewing that covered period, that you can be granular as far as what you allocate to the PPP and what you allocate for the employee retention credit. So for example, if your covered period starts on April 1st, you may not want to start your PPP wages until June 1st so that you can take advantage of that shelter-in-place order that was put in place by Governor Kemp. So again, without further guidance from the IRS, we're interpreting that these wages can be allocated even down to the individual employees. And we'll talk about that in a minute when we look at a strategy. I threw another slide in here too, because we're seeing this a lot on some of these PPP forgiveness applications. So again, this is the same example where you have $200,000 loan, but the employer really wants to make sure that there's no chance this loan is not going to get forgiven. So even though he only needs $120,000 to meet his 60%, he's going to go all out and put his full $300,000 in wages on his application, which is way in excess of what he needed. The IRS came back and ruled and said, if you put wages in excess of what you needed, those wages can be eligible for the employee retention credit. So they did come back and let us know that was a positive from that perspective. So again, it's not going to hurt somebody that's already applied and maybe put in excess of wages. However, on your application, if you did not put any other cost, which would be the 40%, you are precluded from doing that. So you cannot go back and say, well, I had cost. I want to go back and amend my PPP forgiveness application, and they're not going to let you do that. So again, so gave us some flexibility and came out with some decisions that we have been waiting on. All right, so from a strategy perspective, let's just say you've already been forgiven or your application has already been submitted and you're just waiting from the SBA, but you feel like that potentially you qualified for this retention credit, go back and look at, what you use for your covered period, and look outside of the covered period, the wages that were on the front end before or after that period. Also look at your application. Who are your highly compensated people that you had to limit their wages that you used? They can also be used potentially for the employee retention credit. Also look for costs that maybe you didn't use in the application. Maybe you didn't need health insurance. Health insurance qualifies for the employee retention credit, so consider that. And then evaluate each employee again to see if there were any that you did not use for whatever reason on your application or your PPP application. All right, let's just say you're not forgiven. So you're one of the ones that have been waiting and for whatever reason have not submitted your application. Again, evaluate your covered period. Evaluate what's going to make the most sense for you to get full forgiveness, because for the highest and best use of your dollar, you do want full forgiveness on that PPP loan. ERTC would be next in line. So consider, what wages will get you there quickest for the PPP. Again, consider your non-payroll costs. Make full advantage of those or full use of those to get you to your 40%. So again, that protects your wages to be able to use them for the employee retention credit. And then also look at your employee turnover and your utilization. So if you've got a lot of turnover, it may make sense to use those wages on the PPP versus the ERTC. So again, it has to be an evaluation to see where it might fit, and it might take running a couple of scenarios to determine that. All right, new loans in 2021. So a lot of folks are actually getting round one for the first time and actually going into round two for the second round of loans. And just as a side note, we learned yesterday that we're hoping there's going to be a vote today to extend the PPP process, which is currently set to expire on March 31st, to extend it to the end of May. So we'll be looking for that and try to get something posted on that as soon as we know today. But it's going to Congress, and all indications say the president will sign it pretty quickly. So that'll give everybody who is still kind of sitting on the fence a little bit more breathing room on whether to apply for the first or second round of the PPP. But let's just say you've just applied, you've got your second round. So things to consider is go ahead and let's run a projection and see what this is going to look like and see how quickly you'll be able to use the PPP loan. Also, evaluate it quarterly. Don't be in a rush to apply for forgiveness. Wait until after your cover period to even evaluate the ERTC and the PPP to make sure that you're allocating those wages to the proper program, whether it be the PPP forgiveness or the ERTC. So again, super important to plan and not get in a rush on this. All right, some resources that we've got, and again, you'll get this in a link, but here are some of the IRS links. Obviously, feel free to reach out to us. If you do have questions, use the Q&A chat to send us a question. We'll get back to you in just a few days. One of the things to point out, though, on the IRS website, the very first item on here, which is the notice 2021-20, that is kind of your go-to right now for the employee retention tax credit. The IRS has a web page devoted to the credit. However, it has not been updated for these last two acts that were put in place since December. So be very careful if you're going to that. I would use the notice first. Also links for if you want to look at the new 941 and the 941X, those have been updated. As Alison mentioned before, we're looking for a new 941 for the last part of the year. And then, of course, there's a Small Business Administration links that will give you the forms for the PPP and give you any updates that's going on there now. So I hope, well, we're right at our 1 hour, so I'm glad we haven't kept you too long. We do have Brittany is going to post for us in the Q&A chat. If you'll look, there'll be a link to a survey that'll kind of give us a little bit more information. If anybody needs assistance or has further questions, that we'll be able to give you guys a hand. So we appreciate you taking your time out this morning. We are going to try to continue to get information out as quickly as we get it. Again, we're kind of functioning in unprecedented times where we used to have a tax act once every 4 or 5 years or even 10 years. Now we have them 3 or 4 times a year. So thank you for being patient, and thank you for joining us today, and have a great day.